This week, on stage in Oslo at the Norges Bank Investment Management Conference, Jamie Dimon issued a stark warning about $1.8 trillion of hidden risk sitting inside a market that has never been stress-tested through a real recession. He explicitly raised the prospect of a bond crisis, named stagflation as his worst-case scenario, and reiterated his now infamous claim that when you see one cockroach, there are probably more. All this against the backdrop of oil above $126 a barrel on the back of the Iran war, and Moody's quietly downgrading its outlook on U.S. business development companies to negative. So in this video, we're going to explain what private credit actually is, why Dimon is warning about it now, and whether the Iran war could be the catalyst that turns dormant credit risk into active defaults. Never miss an episode and always feel in the loop by subscribing and ringing the bell. So let's start by explaining what private credit actually is. For context, private credit refers to loans made to companies by non-bank lenders, typically asset managers, insurance companies, and dedicated debt funds that don't trade on public markets and largely sit outside traditional banking oversight. The asset class has grown roughly tenfold since 2007, reaching around $1.8 trillion in direct lending today, with broader estimates including dry powder pushing toward $3.5 trillion. Moody's projects the market could hit $4 trillion by 2030. This explosion is largely a consequence of the post-2008 regulatory regime. Dodd-Frank, the Volcker Rule, and Basel III made it considerably more expensive for banks to hold leveraged corporate loans on their balance sheets, and non-bank lenders moved in to fill the gap. It's worth noting that these loans are typically marked to model rather than marked to market, meaning valuations rely on internal assumptions rather than real-time price discovery. As Dimon himself put it, when defaults eventually surface, they can sit hidden on balance sheets for quarters before showing up in reported numbers. However, the warning signs are already visible if you know where to look. The Proskauer Private Credit Default Index rose to 2.73% in Q1 2026, up from 2.46% the previous quarter. Fitch, which includes distressed exchanges in its methodology, puts the trailing 12-month default rate closer to 5.8%, and Morgan Stanley has projected defaults could reach 8% in a stressed scenario. There are also concrete examples piling up. In Q1 2026, Blackstone's BCRED fund, the largest semi-liquid private credit vehicle at $82.5 billion, faced $3.8 billion in redemption requests, equivalent to 7.9% of its NAV. That exceeded the fund's quarterly cap, forcing Blackstone to raise the limit and inject $400 million of executive capital to stabilize it. Ares Capital, meanwhile, reported $155 million in net realized losses in Q4 2025, roughly 5 times the figure from the same quarter a year earlier. And back in September, the auto parts company First Brands Group filed for bankruptcy with around $10 billion in debt. The public window into the sector, business development companies, is flashing warning lights too. Public BDCs are currently trading at roughly a 21% discount to net asset value, their deepest discount in over 5 years. KKR cut its distribution from 70 cents to 48 cents per share in the first quarter, Golub Capital cut from 39 cents to 33 cents, and Moody's downgraded the outlook for U.S. BDCs to negative in April. So, why is the Iran war the obvious accelerant here? Well, the mechanism is fairly direct. The vast majority of private credit loans are floating rate, meaning every basis point added to the policy rate flows through to borrower interest expense almost immediately. Oil at $126 a barrel has pushed U.S. CPI back up to 3.3%. The Fed has held at 3.5 to 3.75%, and market expectations for rate cuts have been pushed out into 2027. For context, the largest borrower categories in private credit include energy-intensive manufacturers, transport firms, and chemical producers, exactly the companies hit hardest by the oil shock. With roughly $480 billion of private debt maturing over the next 18 months and the 10-year Treasury hovering around 4.4%, refinancing is now a margin compression event for almost every borrower. We would note, however, that Dimon himself has been careful to caveat the warning. He explicitly said, "Private credit is not a systemic threat in the grand scheme, given it sits alongside a $13 trillion investment-grade bond market and a $13 trillion residential mortgage market. He's forecasting a shakeout, not a 2008-style collapse. The point we're trying to make is that what Dimon appears to be signaling is something more specific than collapse. That a decade of cheap money, opaque valuation, and untested fund structures is finally meeting its first proper credit cycle. And the unwind, if it comes, will land disproportionately on the pensions, insurers, and increasingly retail investors who absorbed most of the growth. Ultimately, whether the cockroaches in private credit turn out to be a handful or a swarm will depend largely on how long oil stays elevated, how patient floating rate borrowers can remain, and whether the next wave of refinancings can clear at rates these companies were never underwritten to survive.